Nigerian stocks fell on Tuesday, dragged down by significant losses in major companies like Honeywell Flour Mills and FBN Holdings. The NGX All-Share Index closed down 353.51 points. This decline follows a trend of decreasing returns, representing a one-week loss of 0.5%, a four-week loss of 5.01%, but an overall year-to-date gain of 32.82%. Well, that's another drop compared to previous, reading. Despite falling stock prices anyway, trading activities surged on the NGX. That's when we look at the volume. Anyway, beginning with the All-Share Index, let's take a look at the breakdown of activities from yesterday. Now we'll begin with the All-Share Index. Just like I pointed out, we have a percentage change of 0.35, and then the index closed 99,311.54. Now let's check out what we have for market capitalization from yesterday's trading activities. For market capitalization, we have it closed there 56.18 trillion naira. Now to the top gainers from yesterday's market. For top gainers, we have Sunu Assurance closing 1 naira 10 kobo after gaining 10%. Japo Gold gained 9.84%. CAP gained 9.38%. Omatech gained 9.21%. And Prestige also gained 9.09%. And here we have the closing price as of yesterday. To the top losers from yesterday's market now, we have Honeywell Flour losing 9.89%. FBNH, that's FBN Holdings losing 9.88%, Oando losing 9.82%, FTN Cocoa losing 9.40%, and Nestle losing 8.89%. And here you also have the closing price. Well, basically, let's get to sectoral performance. And talking about the sectoral performance, key banks, that's the SWOT, that's the stocks with over 1 trillion, are actually dragged down the market yesterday. We had Zenith Bank falling by 5.01%. We had GT Bank dropping by over 2%. Of course, UBA had, slight gain yesterday, but this is what we have. And we also had some stocks in the industrial goods that also sort of helped this particular sector. So looking at the sector performance, we have banking minus 2.94%, insurance minus 0.51%, oil and gas that we have it there. I mean, just the way it has been for a while now. For consumer goods, that's another drag, 0.80%. But then for industrial goods, we see something quite interesting over there. They have an addition right there. That's 0.30%. And you might as well blame this, or you can say you can attribute this to telecoms and cement stocks, basically, because those are the ones that sort of fall right here. And that's why we have that positive close right there on this particular sector. Well, we'll take a break, and when we come back, we'll have a first conversation for today on Business Edge. Stay with me, don't go away. Nigeria's Lagos Commodities and Futures Exchange, LCFE, will become the first commodities exchange in the country to trade crude oil and gas, aiming for 50 million barrels annually. What benefits will this offer domestic refiners, and what are the inherent challenges? To unpack this, I am joined by Olufemi Oladeye, Group CEO, Petrolex Oil and Gas Limited. Thank you for joining me today.
Thank you very much, and good morning.
Good morning to you too. So let me begin with, this. What's your thought, or what are your thoughts on this?
Look, I mean, I think it's a positive development. The market has consistently looked for alternative platforms. And just thinking about it, that most of the crude that has been produced by the Nigerian market or the Nigerian producers obviously always ends up outside of Nigeria. To then now have a platform where Nigerians can actually, or Nigerian corporates and QIs can actually start to look at potential crude trading as both an investment opportunity as well as a source of getting crude for either their refineries or the other places where they want to use it. It's actually quite a positive development. I think we are quite excited about it because obviously our expectation is that from crude would actually move to the trading of other products, like byproducts of the crude itself, especially once our refineries go back to working.
Well, that's something a lot of persons will look forward to trading, beyond just the crude and getting to other petrochemical or what have you. Now, let's look at the dynamics of crude oil trading and, how prepared do you think the Nigerian market is for this?
So I think it's still very early days. One of the things about trading, as you know, is that there are certain off-the-system structures that are required for you to have an effective trading mechanism. One of those is storage and security. So basically, if somebody comes to the market and trades 50,000 barrels of crude, for example, there must be an independent storage that confirms that that crude actually does exist. because otherwise you're going to then have failed trades. And that's one of the things you want to avoid, especially when the market is just developing. So I would say from an infrastructure perspective, there has to be some thoughts around how do the products get stored? How does the effective transfer of ownership happen after a trade has occurred? You know, if you look at stocks, for example, you have the CSCS, the central storage for all stocks. So when a settlement happens, the settlement happens at the CSCS. And when it comes to commodities, it's a completely different end game, because you're actually settling physical assets when commodities are being traded. And I think that for us, one of the big elephants in the room would be how is storage of the crude that is being traded being treated, and secondly, how can you get security over storage to ensure that trades do not fail.
All right, do we have steps, being taken now towards addressing these issues? Because it wouldn't be nice for the LCFE to say we want to do this, knowing that maybe there isn't really enough infrastructure to support this. Are we having, that conversation ongoing now to support what they are trying to do?
So, look, I mean, yes, there are ongoing conversations, and I think probably it's a good time for us to also talk about what an organization like Petrolex is doing in that space. We have probably one of the largest storage facilities in Ibefu in Ogun State, and where we can actually store crude. What is happening is that you must understand that the industry itself has developed over the last 20, 30 years. Most of the storage that we have in the market was towards petroleum products like diesel, AGO, and DPK. But the difference right now is that people are looking at the crude market simply because of the increasing number of refineries that we have in the country. And what becomes key is that can the industry galvanize the required level of capital to ensure that we're able to provide a seamless transfer of ownership of specific products. Now, let's be clear, Nigeria is not reinventing the wheel. So there's currently, anywhere else in the world, you can trade crude futures and you can actually get deliveries. But what happens to us is that because we are late starters, it will be interesting to kickstart our conversation by ensuring that from a logistics point of view, all of those boxes are checked. I believe that the Commodities Exchange has also continued to interact with players in the market to ensure that when cargoes are being traded or when products are being traded, that settlement and delivery become an easy thing. Now, another way to solve that is also to have a robust insurance scheme around the trade, such that when transactions do fail, there is somebody, an independent arbiter, who is able to step in, arbitrate around the reasons why the trades fail, and ensure that the party fulfills its obligations.
All right, beyond the challenges which we hope will be addressed in the coming days, what impact do you think this will actually have on the sector?
Look, I think it's very positive. It's also, and you can look at it from different players' perspectives. From the producers' perspective, so that's the oil and exploration companies, it means that they're able to trade their crude in the local market, which means that even time to market becomes a less complicated problem for them. Now, one other thing that I expect to develop is actually a robust futures market, and that's where things become even more interesting. So it means that as a producer, I can sell in advance production that I haven't yet produced to a local player who just waits for delivery. And that means that, especially because of the challenges that we've had over the last couple of years with short-in production, delays, and infrastructure deficits, that becomes probably a thing of the past. Now, when it comes to the investing public or to the traders' perspective, it just means that we now have additional products that we can trade. So think about it from a portfolio manager's perspective, who's already trading stocks, bonds, and gold. Suddenly, you have another asset class that is actually a good, effective store of value, wherein you can actually trade. So imagine if I bought crude oil futures last year at $75, and today I'm able to sell the same futures at $90, then I would have made some money from it just by keeping hold of cargo that
Let me come in here. What happens when instead of price appreciation, what we see is, depreciation?
Well, so the good thing about this is that, honestly, traders are known to have built some very strong reputations around the integrity of markets. I used to be a trader sometime in my life, and what we say is that as a trader, your word is your bond. It doesn't matter what happens in the market. Once a deal is closed, and you must deliver. And the truth is that historically, there have been very few instances of trades actually failing. So I would say that when it comes to testing market integrity, there is a significant track record on the part of the market for ensuring that the market remains viable. Now, you must understand this. Once a market starts to experience failed trades, that market dissipates immediately. It just falls away into insignificance. So you would see that what would happen is markets would ensure that they self-correct. Now, one way to ensure that we don't have failed trades is what I talked about earlier on, which is more like an insurance scheme around the trades themselves. When you have an insurance scheme around the trades, it means that even when trades fail, somebody else is able to step in, ensure that the trade goes through, and that you can, at the back end, enforce against the failed trader. But what is key is that the integrity of the market is maintained, and then we can then have our own local price discovery, which is something that we don't have today. Most of the time in the market today, we get our own market discovery from the global market. But in a situation whereby we have our own market, then we start to do price discovery locally, and that will be quite interesting for the Nigerian market.
All right, I'd like you to talk a bit more about, the dynamics of a futures exchange, some of the things that can happen and how we might probably mitigate some of the risks. Some of those risks are not just local, they are global. I'd like you to speak a bit around that.
So look, crude oil is a very interesting product, right? It's a very interesting commodity. One of the reasons why is that one of the key drivers of crude oil, for example, is both supply and demand. And to a larger extent, you have socioeconomic and geopolitical drivers of prices. So when it comes to a futures market, what basically happens in a futures contract is that you and I get into a trade that says that in 2 years' time, or in 30 days' time, or in 90 days' time, we're going to conclude a trade, but we're fixing the price today of that trade that we're going to conclude in 30 days or in 1 year's time. Now, what happens is that we would make independent judgments about where we think the direction of the market is going. And on the basis of that independent analysis, we would try to agree a price. Now, there are instances where we're wrong, where we say that, look, the market is going to go up, and we agree a price at maybe $90, and then something happens in the Middle East, and prices crash, and the market is at $90 or at $60. The reality is that because we've entered into a futures arrangement, I have an obligation to deliver the crude to you at $90, and you have an obligation to buy from me, which means you'll be losing out $30 if you try to sell that crude on the day we close the transaction. But that's the way the market works, and traders have been making money and losing money since time immemorial. What is most important for us is we ensure that when it comes to the dynamics of market setting, it's science-driven. Once it's science-driven, then the tendency is that the market tends to respect its own rules. And I think that that's a positive thing for the Nigerian market.
Okay, now away from that, do you see any risks to the exchange's intention of trading approximately 50 million barrels annually and having 10 to 20% of the Nigeria's crude oil production for trading on the platform? Is that something you think is achievable?
If this was a conversation we had 2 years ago, I would have said to you this was completely impossible. It was a waste of time. But you must understand that in the last 2 years, we have the Dangote refinery that has come back on stream, 650,000 barrels a day at peak production. But we're saying even if it's 300, 400,000 barrels, which means that every 3 days, Dangote refinery requires a million barrels of crude, which is equivalent of one cargo. One cargo is now 150,000 barrels of crude. Now, what happens is that if you think about it from that perspective, if all they were doing was trading for the Dangote refinery, you already have your 50 million barrels, or almost your 50 million barrels of crude a day. So now think about it from that perspective. We're now seeing the Port Harcourt refinery probably coming on stream imminently. We're seeing probably the Warri refinery as well coming on stream. And then we have a few smaller refineries as well that are coming around. So the truth is that it's not far-fetched to expect that you could trade up to 50 million barrels of
okay, Olufemi, just before we close, we're going to close on this. I want you to also factor in Nigeria's, current production shortfall. Don't you think that will also have an impact? Let's close on that.
Well, look, I mean, we know that there's a shortfall in production. The government is doing quite a lot to help ease the issues around production shortfalls. Now, what you must understand is that there's significant investment that's going into the oil and gas industry at the moment, and that would mean that a potential recovery in production. And I think that's only going to be positive for the market.
All right, thank you so much, Olufemi Oladeyin, Group CEO, Petrolex Oil and Gas Limited. Thank you for your time on the show today.
Thank you very much. It was an absolute pleasure.
Absolutely. We'll take a break now. When we come back, we have another interesting conversation, and this time we're looking at Nigeria's inflation, and we're also looking at the Naira. Stay with us, don't go away. Our top story today dives into concerns that Nigeria's inflation rate could soar past 34% this April, actually 34.98%. But that's not all. The Naira is also feeling the heat, weakening against the US dollar as liquidity dries up. To unpack these critical economic issues, I'm joined by Kazim Bello, the CEO, Africa Capital and Equity Funds Limited. Thank you so much for joining me today.
Yeah, good morning.
All right, Cordros has projected that inflation will hit 34.98% in April. Does that in any way align with your projection?
Well, thank you for having me. The central bank is doing the right thing. We have actually, global financial analysts have actually advised the central bank before now to conduct empirical analysis before they bring out any policy, so that you know precisely, you can predict the outcome of your policies. But up to now, we've not seen the central bank conduct those important empirical research into what they are doing. So when I heard that the central bank may have, through its internal process, projected that inflation is going to be 34%, it's a welcome development, but I also want to believe that Mr. Cardoso is trying to kind of gauge the market expectations. It is a good thing. I mean, there's nothing wrong in a regulatory body trying to prospect and project market in terms of predictability. We don't know if it's going to be 34.9% like it projected, but we know for a fact that we are going to be stuck with a spiking inflation for a little while, a longer while, as long as we can sustain the reforms that the central bank is carrying out. You see, what happened is that for an economy like Nigeria, there's a lag time between when you institute a policy and the time when the policy begin to manifest or germane in the economic system that you expect it to be. So a lot has been done by the central bank in recent times. Reforms in the foreign exchange, reforms in the liquidity market, reform in the money market, and then we're expecting that the fiscal policy aspect of it will be carried out by the federal government, so that they can support the federal government in controlling the liquidity in the market. And then that way, the CBN can be able to project inflation and be able to determine what to do, maybe in the next MPC meeting or whatever meetings they may be holding in order to project the economic situation. So I don't think 34% is really a bad number. It's
34.98, that's almost 35.
You said it's 39.4.
I said 34.98.
That's about 35%. The global projection in New York market, where I come from, is that we are going to be seeing about 37, 38% by end of April, going into May. But if the projection by the CBN says it's 35, I guess it's a welcome development. It means that whatever the central bank is putting in place is working for them and is working for the economy. But again, the central point here is that the central bank also recognizes that we got to be dealing with this inflation, spiking inflation for a period of time before we start seeing the respite and when it will begin to decline from the weight of the policy being put in place.
Well, talking about this, this was something that was brought to bear, or that was brought to the fore by Cordros Capital analysts. They were the ones who actually made this projection. Well, moving away from that, we see some of the base effects that are responsible for what we're seeing in Nigeria's inflation figures. Talk about exchange rate pass-through, talk about food inflation, and some other things, really. So looking at exchange rate pass-through and the challenges impeding food supply, these two stand out as factors affecting inflation in the country. And, and just when we thought we're bringing some stability to the foreign exchange market, we saw what you might want to call a relapse of some sort. And then, but we'll come to that later. Let's focus on the factors affecting, food production in the country. What do you make of this? Do you think enough is being done to address this? Because this will definitely have a ripple effect in bringing down the numbers.
Well, there's absolutely no doubt that we arrive at this inflation problem in Nigeria not by sudden occurrence of anything. It was the cumulative effect of wrong choices in policy implementation. If President Tinubu had not decided to reform the foreign exchange market and drop fuel subsidy and the rest of them, we would still have been saddled with inflationary pressure. There's no doubt about that. We will not escape it. But those changes that the federal government is carrying out is extremely necessary. We need to reform the system to allow market-based dynamism to foster our economy. And going back to the question you raised, yeah, I mean, it's if you look at the dynamics of what is driving the inflation effectively, again, a lot of it has to do with wrong choices. But a lot of us are crying about food security, food inflation. And yes, the main driving force is the food inflation, which is already spiking at about 40% or a little bit above 40% right now. But we know what caused the food inflation. Number one, the 2022 flood actually was extremely devastating. It actually led to a lot of shortages, coupled with the fact that there's insecurity in most of the food basket region in Nigeria. The terrorists and the bandits has driven farmers from their farms, and this has affected cost of food because there are not enough food to be produced. And again, you have to deal with the issue of energy costs that also affect transportation of food from the hinterland to the mainland, where you can actually determine their prices. But again, I want to believe from my perspective that it is a good thing for Nigeria because either to now, we actually have a very destructive pricing system for our agricultural product. We need to be very factual with ourselves. I mean, a lot of those foods do not have a shelf capacity to be able to determine the prices that is what in the market. You bring out a tomato, and then if you don't bring it to the marketplace in the next 24, 48 hours, it perished, and the farmer loses. But if you are able to have a storage facility for it and be able to predetermine and speculate on the prices, the farmer might be able to earn more. I mean, this might be a wake-up time, a wake-up call for Nigeria to invest in those infrastructure so that moving forward, we can practically price our agricultural product, and then based on what we have, the population can be able to purchase at the right price and without having to expel inflationary pressure in the pricing itself and the supply chain. The inflation was caused by supply and demand dynamics. There's a real big shift, declining supply in the face of rising demand, and people must eat, and that is a very huge portion. The next to it is, of course, the price level system that is defective by the exchange rate that we have, and of course, the fiscal spending by government. The last government in the last 18 months spent close to about $13 trillion in the economy that was not necessary, and that itself created a lot of pressure on the liquidity. So those are the things that essentially are causing the pressure on the inflation. And again, it's going to be trending for a little while, and then based on the optics of the policies that is being put in place, we will be beginning to see a decline in the inflation. I really don't know. The CBN projection is that by the end of the year, we should be looking at 22%. I hope we can be able to get that. That also is a factor of other factors can play into that, because we cannot just sit down and say it's going to be 22%. We have to also work towards that by implementing the right policies.
Let me just put it straight to you. Do you believe we can actually achieve that 21 point, maybe 47 thereabout?
You mean the inflation?
Yes, please.
I didn't get that question right.
Okay, you were talking about CBN's projection, talking about wanting to achieve 21% inflation in the year 2024. So I'm asking you, just put it to you directly, do you think it's something we can achieve? With analysts already talking about another upward movement in inflation figures, talking about us expecting 30, that's a 34.98 in April. Do you think we can still achieve that 21% that the CBN hopes to achieve?
Again, that's what I said earlier on. That's the earlier projection from the CBN. I hope somebody will not try to tickle with the numbers without actually empirical evidence and facts to support those things. But let's assume that everybody is going to play according to the game. Naturally, personally, I don't see the inflation declining to 22% or 21% as projected by the central bank before the end of the year, because we have to also understand that whether we like it or not, the federal government has a budget to run, and there's a lot of money coming out of the federal government now to reflate the economy, to support the businesses, and to support the governors, the state government, to support agriculture, to support health system. So those are funding that is going to still impact on the liquidity system.
Okay, so, just before we go, Mr. Kazim Bello, let's talk about the exchange rate. Now, Naira weakened to a one-month low of 1,300 Naira. And, some persons have blamed this on dollar illiquidity. What are your thoughts? Let's just close on that.
Well, you really cannot blame it on anything other than the fact that the attempt we are doing now is to figure out how to balance the market operational dynamics. It is what I would call an experimental stage for us to actually, to me in person, do the right thing that is acceptable globally when it comes to foreign exchange management. What we have been done either to now has been administrative fiat operation. And behind that, we have also seen a lot of what I would call illegal, illicit practices behind the foreign exchange, things that we not expected to do. The only thing that drove foreign investors, especially portfolio investors from Nigeria, wasn't because the Nigerian economy wasn't buoyant. It was because a lot of them cannot understand how we can be managing the foreign exchange market the way it was managed in the past. So now that we are trying to bring sanity into that market, the market itself will have to form an equilibrium. And the process of forming an equilibrium doesn't just happen that way, because you are allowing the market forces to dictate the pace of the market exchange rate. So the rate is going to be going down and up until it finds a balance, and then we can then scale up with that.
All right, thank you so much, Kazim Bello. I hope that balance comes in as quick as possible. Thank you once again for your thoughts on the show today.
Thank you.
All right, and up next, we'll be talking about Nigeria seeking fresh $2.25 billion World Bank loan. Stay with us, don't go away. Nigeria seeks $2.25 billion in World Bank loans for development and program-based financing, with approval expected in June. The government also plans diaspora bonds to attract foreign exchange. This comes as Nigeria faces record debt and aims to reduce central bank reliance. Joining me for more on this is Muktar Mohammed, the CEO, Asher Investments Limited. Thank you, Muktar, for joining me today.
Thank you for having me. Good morning.
All right, so, you have the story already. Nigeria seeking up to $2.25 billion in World Bank loans. What was your initial reaction to this news?
Well, we are looking for loan everywhere as a nation. We call the loan these days inflow. So anyway, anyhow we can get inflow, want to get inflow. So I think it's all about inflow, trying to have inflow so that you can begin to balance the exchange rate. I think it's all about inflow, liquidity. So how we get the liquidity is what really matters to us. Like I always say, we are looking for a short-term solution first, then medium term, then a long term. So for now, I think I don't have a problem with that. And when you look at the loan, Also, the time and the interest rate is not bad. Again, my little challenge is that in terms of this loan, sometimes the administration that takes the loan don't seem to be the one to pay. Some other administration will come and carry the loan. So, but I think if it's judiciously used for what it's going to be meant for, it could be something that could help the Nigerian economy.
But isn't this a cycle, that just continues and continues and continues? We're getting loans to stabilize the currency. We're getting loans to probably pay back what we're owing and all of that. I mean, the debt isn't reducing, rather, it's increasing. And even I do not think revenue is even increasing as much. So at the end of the day, is this even good for Nigeria?
Roger, we find ourselves where we are, and I think I totally agree with you. It's robbing Peter to pay Paul, then after you rob Paul to pay Peter. But I think the government really need to do something. They think the only way they could do it now is to boost liquidity. I think it could be different compared to what we normally have before, whereby some of this loan comes in, we don't know what they are used for. Hopefully, this will be different. And again, we're talking about stability to attract inflow. So 2.2 something billion dollars to be having a moratorium of about 10 years, paying in the 11 year at 1%. I don't think it will be too much of a loan for us that we won't be able to pay when you compare with the kind of loans that we debts that we are really into. So, but I get your concern, but it is what it is now. We have to do what we have to do. And like I said, this is a short-term measure. Hopefully, it shouldn't be a cycle, like you said, just a short-term measures to see how we can stabilize rate, then attract inflow. I'm very optimistic that in the next 3 to 4 or 5 years, we will attract inflow more than $2.25 billion that we've collected from the World Bank. And those inflow will be able to have a snowball effect to attack, have positivity in every space of the Nigerian economy. So hopefully, I'm hopeful that for the short term, this is just a short term measure. It shouldn't become a tradition whereby we keep on going one way or the other looking for facility. One thing I need to make you understand is that if you look at Egypt, if you look at all countries that have follow the World Bank or IMF policy like what we have done here, remove our subsidy, floating up the exchange rate. The World Bank or the IMF have actually helped them in one area or the other to boost liquidity so that they can have they can maintain a robust reserve. This is what we should have done before floating the currency, just like the Egyptian did. But we've done it, we floated the currency before we're doing it. So it now seems like if we are begging them to give us liquidity. Remember that before now they promised to help if we are able to implement some of these policies. And I think part of the help is what the Nigerian government seems to be asking them now.
All right, well, beyond this help and some other form of help, that we are expecting or we are going for, and there, other factors that can actually help us boost liquidity so that we can, whether it's the production side and the other things we need to do beyond these short-term fixes, something more structural, something that can last even longer.
I agree with you, Professor. Structural, that's the word. And I'm excited what the CBN governor said in the spring meeting, in World Bank spring meeting, where he said that they will come up with a diaspora bond and they are working in connection with the diaspora commission, which for me is fantastic. Remember the time ago, diaspora remittance was even higher than the money we made on oil. So I think that is a good one whereby you begin to get diaspora bond like what has happened in developed countries now, like India, that's what they have done to stabilize their rate when they export their intellectual properties. Indians abroad tend to invest in their country, like a partnership between government, very organized. A lot of Nigerians want to invest in Nigeria, but because of the sometimes some of them have got their finger burns, whether by relative or friends. So when you see an organized product like what they are doing, they are about to do, and I think they will key into it. Hopefully, that will bring in remittance into Nigeria. I'm talking about these are long-term solutions, and that will also help. Secondly, again, we have to begin to look at our export in the sense that the good news is that before June, hopefully by the middle of this year, we will stop importing refined petroleum products of any kind into the country. That also will help us reduce the pressure on the naira to dollar exchange rate. As it stands now, we no more import diesel into this country. We can get it in Dangote, and it's even cheaper. It's going down by the day. So that also is a game changer that will help. So now Dangote itself now will be exporting refined petroleum products and other products out of the shore of this country, bringing in FX into this economy. That also is good for us. NNPC said the Port Harcourt refinery will soon be ready. Hopefully, they will be able to meet local production and then begin to export. So with that, you can now begin to see a long-term solution. And then we need to look at the non-oil sector and see how we can drive that sector also, because when you look at the oil sector, once there's an external shock, it tends to affect us. But the good thing about it is that if we are able to maintain local refining of this Nigerian petroleum product, that even when there's an external shock, it may affect our revenue, but it will not affect the cost of living like what is happening now. So I think that is what they should do in the long term. But again, you don't, because those selected solutions need a lot of strategy, they need a lot of resources also. And some of these resources are not there, because I always say for you to develop on that stream of income, you need to use the other stream of income to develop the other stream of income. So let's see how we can boost our revenue, especially FX revenue into the economy. Then you begin to use that to begin to develop other states of the economy. I look at an oil producing nation like Saudi Arabia. They released their report sometime last month or the beginning of this month, and they said their non-oil exports drove about 50% of revenue into their economy. I just look forward to a day that will say 50% of our revenue FX that have come into our FX reserve is from the non-oil sector. That would be a game changer. So we tend to look out for that, and hopefully they get it right.
Well, we also look forward to that here. Thank you so much, Muktar Mohammed, CEO, Asha Investments Limited. Thank you for your thoughts on the show today.
My pleasure. Thank you.
Well, that's it on this edition of Business Edge. You can follow us on social media. We are at News Central TV. You can also log on to our website, www.newscentral.africa. Thank you for watching. I am Perpetua Fasano Peter. Bye for now.